pitfalls in a rising market. So as usual, we will first start off with a little bit of news flash, recent news. So the one that I really wanted to talk about is the Singapore census 2020. So what it did, it tracked, it did a survey of the population to see what are the preferences, what are the data for the population. And the data that I thought was most interesting from the census was this table. So in the year of 2020, this year, the group that took up the largest proportion, that means the most people that were the biggest group, right, were earning an income of 20,000 and above, and this is combined household income. It's quite surprising. It caught me by surprise, and the change from just 2010 is extremely significant because in 2010, the group that was occupying the largest percentage at 16.2% was at $3,000 to $5,000 combined household income. Today it's at 20,000, the group that is the biggest group. In the year 2000, 20 years back, the largest group was occupied by people with a combined household income of 1,000 to 3,000. So that is a very clear indication of the increase in affluence in the Singapore household. Just for some perspective, a combined household income of $20,000, the loan eligibility that a family like that can take, assuming a 30 years loan, I think assuming a 30 years loan is 2.6 million based on total debt servicing ratio and assuming there's no debt. And that would translate into a purchase price of 3.45 million. That's not the only data that I found interesting. So this was another article, and this was from yesterday actually. So Credit Suisse did a report consolidating the high net worth individuals across the world, and what they said for Singapore was that they expect a 61.9% increase in millionaires by 2025, which is not that far away, 4 years from now. They expect an increase in the numbers from 270,000 today to 437,000 in 2025. So the census and the Credit Suisse report seems to be pointing in the same direction, that there is going to be a significant increase in affluent Singaporeans moving forward. And the census also gives us some clue as to why this is happening. They have mentioned that over 50% of married couples today have dual careers, meaning the husband and wife both work. And also another data shows that couples are getting married later and having kids later also. They prioritize their careers. They want to ensure that they are on a strong financial footing before getting married and having kids. What that results in is a higher disposable income for them to spend on things like private properties, which is why we see an increase in preference for private properties, an increase in percentage of population that is staying in private properties, increasing from 11.5% to 16% in the last 10 years. And all of this, we actually did see it coming. We put that into our predictions video, predictions for 2021 video, where we predicted that landed properties, the price will see a significant increase. And also, we predicted that there will be a high demand for larger units, which is what we see today. I will elaborate on them a little more later on. I'm going to put the link to the predictions video in the description as well. So how did we see this coming? It's more of a on-the-ground sensing of sorts because of the type of clients that we were speaking to, and then we realized that Singaporeans are really sitting on quite a lot of cash. But now that we see the census data, it sort of backs up what we were feeling on the ground. And guess that's the benefit of being on the ground, because we get to have first-hand information by speaking to buyers and homeowners in the market before the data comes in, because the census data comes in one every 10 years. So being able to experience that on the ground sensing firsthand allows us to act on it, right? And share that information with you guys quicker. So if you want to see what else were in our predictions, right, just check it out in the description, right? The link is in the description below. So what are some of the other points I thought was relevant or good in the particular article that we shared? The resident household increased from 1.15 million to 1.37 million. The MSF defines resident household as a household basically anchored by at least one Singaporean or one permanent resident. So why so? We attribute it to an increase in singles, which was also indicated in the census, right? And a growing demand, basically more and more people also taking up PRs, more and more people moving out and staying on their own. So this increase in resident household, the number of resident households, is an indication of the strong organic demand in the Singapore property market. Okay. The other thing that we saw is a decrease in the numbers living in HDB flats. This is somewhat of a very logical deduction, because the increase in the numbers staying in private properties will represent a decrease in numbers in HDB flats. Okay, Leong, I would like to think couples earning, yep, that makes sense as well. The loan tenure, the loan amount, loan eligibility should be pretty similar also lah. Wouldn't vary by much for 30 years to 25 years. So let's move on. Hi Kit. Okay, sorry about that. I will come back to the comments at the end of the video, so pardon me. If not, later my train of thought gets affected. Okay, the other article that was interesting is the private property supply. The land supply has been increased by 25%. I had quite a number of people who texted me and said, hey Alvin, the percentage increased by 25%, that's quite a lot. Would that affect prices? And that is very natural, very common. If you have economics fundamentals, it will be very commonsensical, right? But the 25% increase, it's not going to affect the undersupply scenario that we are seeing by much. We are still going to see a huge undersupply in the market. And how the government has very cleverly navigated this is by putting more properties on the reserve list rather than in the confirmed list. So in the reserve list, the developers have to come into the market and trigger the tender before the land gets sold. So basically they put it out there. If nobody bid, if the developers don't come in to bid, the land is not sold. And they are not flooding the market with supply. But what is interesting that I noticed, so this article is today, 2021. I show you the next article. The title, the wording, the contents in it is extremely similar to the article today, and this was dated 2016. So it's something that we keep saying. the supply, what is happening today is very, very similar to what was happening in 2016, down to the fact that even the news article seems like the same. The wording in the news article is very, very similar. So how do we use this to our advantage? I think that's the important question lah. So for those who are joining us for the first time, right, I will do a very quick run through on this table. So for our loyal supporters, like Kit and YK, right, you guys hear this every single month, so pardon me, but it is my favorite chart, and there's a lot that we can take away from this chart. So in the article, right, remember 2016, the government started to kick up the land supply. Why? It was because the developers were you see this table, right? Over in 2016, that article was Q2 2016. So it was when the developers' inventory started to dip below the 20,000 mark, and the government noticed that the developers were short on supply and they had to come into the market, so they were trying to feed that demand to avoid property prices from shooting up too much. That said, they didn't do a fantastic job, because once they released that land, apparently it wasn't nearly enough, and that resulted in the en bloc rush that we saw in 2016, 2017, ending in 2018 with the cooling measures. So it's very, very similar scenario to today. Today, the outstanding developer stock should have dipped below the 21,000 mark already. So it's very, very close, because this chart was done last year. So today it's going to be dipping under the 21,000 mark very, very soon. And similarly, the government is taking that as a trigger, and they are releasing more land supply. But there is a difference between what was happening in 2016, 2017. We all know what happened after that lah, right? The 2016 lack of land supply, developers came into the en bloc market, and that triggered a surge in the market, so much so that the government had to come in with cooling measures in 2018. But today, right, while similarly we have a short of supply in terms of developer stock and in terms of land, we have on top of that, right, concerns on inflation due to low interest rates and due to quantitative easing, not just from the United States, but also from the Singapore government, right? Last year, the government has put out close to $100 billion in extra funding, right, from the reserves to hold up the market because of COVID. And all this money being forced into the system is creating inflation. And you see in this part, property and gold, demand tends to go up for both asset classes in an inflationary environment, as they are favored as hedges against rising prices. So that is one thing that is different. The second thing that is different is the lack in manpower. So this was also another article from last month, right? The government it's very cautious in terms of releasing too much land supply, because they know that there is a shortage of manpower. So if they release too much land, there's not enough manpower to build the land, and that's going to result in even higher prices, because the developers have to spend more money hiring manpower, and they will be charging that back to the consumers. So it's a very, very fine balancing act, which is going to bring me to the next slide. I'm not sure if there's many of you who have watched this show, The Perfect Storm. I thought this was very apt, and a very apt example to use, because there's a lot of factors that is basically causing the property price to be like that boat over there. The increase in developer demand for land, the upgrader demand, because the HDB market is so hot today that a lot of owners are deciding to cash out on their HDBs, and they have to buy something else, and they are moving towards the private market. We have new benchmark prices being set with our recent Ang Mo Kio land sales, with developer break-even prices, expected sale prices close to 2,000, in excess of 2,000 per square feet. So that's the next benchmark price. And people are going to realize that the next benchmark price, which is perhaps the top of the boat, the top of the wave over here is so much higher than where we are today. So the prices will be catching up to that real soon. We have a lack of land supply, as the previous slide has shown. We have a lack of manpower. We have low interest rates. We have quantitative easing and inflation coming in. So all these factors are basically forcing real estate prices up, bringing us to the point that we want to talk about today. How do we navigate an environment like that, whereby it seems like it's an impossible wall to tackle, because we are this little small boat in that ocean? So these are the market sentiments in the market at this point in time, right? There's a lot of FOMO in the market, right? So those of you who are with us, right, help me put in the comments, right, what do you feel is happening in the market? Maybe Kit can share, YK can share, Matt, right? A lot of FOMO in the market. What are you guys feeling? A lot of FOMO, people are complaining, need to wait very long, there's not many choices, the prices are very high, yeah? Let me know. Hi, Jin Xian. And I would boil down all this into one point, the market sentiments into this one point, which is mindset. To be honest, the fundamentals of the market have not changed. What have changed is the mindset. Yeah. While we at the Right Move, we are very data driven. Those who follow us know that we are very data driven, very fact driven. Property and all forms of investments, as a matter of fact, have a very strong emotional factor to it, especially property, because there's a mixture of investment and own stay. And it's something that is not really talked about. So the mistake people make is that they enter a property purchase with the wrong mindset. For example, right, I have spoken to people who ask me about what can they do, because they have sold their house, they have bought a new launch, and they are now gambling that the new launch will make a profit, and they are hoping to sell at TOP, right? I also have spoken to people that have been advised to sell their HDB and buy 2 one-bedrooms, and these guys have families. They've been advised to sell their HDBs and buy 2 one-bedrooms and try to flip upon TOP. And I just feel these aren't the most ideal of mindsets, to be very honest. In other words, another way to put it, overly optimistic. So a second potential pitfall that I see is happening in the market today is the lack of understanding in the fundamentals. Okay, so a lack of understanding in the fundamentals will create a lot of uncertainty in what's going to happen in the future, because you can't predict what's going to happen in the future if you don't understand the fundamentals, right? And that will result in a lot of fear. And if you still cannot understand and that FOMO is too strong, you end up just following the crowd. The problem in that lies with what the crowd does not mean it's the best choice for you and your family and your investment horizon and your investment profile and your income, so on and so forth. Yeah. And the last point, potential pitfall, is a lack of understanding of the potential exit strategies. And I see this in 2 parts. First, a lack of understanding of potential exit strategies today. The property that you're staying in have multiple exit strategies. It's not there isn't just one exit strategy selling. There are a couple of exit strategies involved. Number 1, so understanding the exit strategies you have in your property today. And the second one is understanding the exit strategy for the property that you're going to buy. Because if you are unsure about that exit strategy, it may be hard for you to exit in the future, right? And if anything happens because your exit strategy is not firm, not solid, it tends to result in a lot of uncertainty, a lot of stress because you have already bought that property. So how do we address all these potential pitfalls? It's to have the right mindset, right? So how do you navigate this uncertain market properly? Have the right mindset. A wrong mindset will result in wrong expectations, and wrong expectations will result in disappointment. Remember, properties should be seen as a long-term illiquid investment like they have always been. If you want to see it in the short term, right? If you want a short-term flip, you should only see it as a bonus if you can achieve a short-term flip. But you should not enter it with the mindset that you have to sell in the 3 to 5 years time frame. Yeah, so notice there's a significant difference. While you can potentially sell within 3 to 5 years, but that should not be your all-in bet, so to speak. So number 2, expectations, right? So I put in here time versus money. You can't have the best of everything, and I think what is stressing a lot of buyers out in the market today is the lack of time, right? Because they have to wait so long to collect their keys and whatnot. So they are forced into moving into the market, the resale market today, and have to basically challenge with a lot of people to fight for a particular unit. My advice, right, is in real estate, properties are made by those who have the luxury of time. For example, those who buy BTOs, ECs, and new condos, right? They bought it 3 to 4, they bought it at launch, they have to wait 2 to 3 years. So that's the reason why when they sell it after TOP, they have to sell it for a profit, because they want to make back the amount of time that they have to wait to collect the keys. They are not going to sell you the same price. They're not going to sell you the same price that they bought after waiting 3 years for the particular property. After waiting 8 years, if it's a BTO, 3 years to build and 5 years MOP. So if you can afford to wait, and I guess it's a especially tough choice today with BTOs having to wait 7 to 8 years to collect keys, right? If you have to go into a resale HDB, what is the mindset? It will not be for profit. Personally, I will spend as little as possible if you are going down that route. So it's like a 10% drop in the price of that HDB. Of a $400,000 HDB is $40,000 versus a 10% drop in an $800,000 HDB, that's $80,000. So why I say so is because I don't expect this HDB price uptick to be sustainable and to last forever, because it was primarily caused by COVID-induced delays. For those who still hope to profit, so you got to look out for alternative exit strategies that allow you to buy a second property to hedge against that potential loss. There are ways even with buying a HDB to do so, but I will not be able to share that in a public forum, because if I share that, then that loophole gets closed and then we all got no option anymore. So hit me up and I can share that with you personally. Next point, right, to have a really strong grounding of the fundamentals. So like I mentioned, what's happening today is very, very similar to what is happening in 2016, 2017, 2018. So having a clear understanding of what happened then, what are the properties that did well and did not do so well during that period before the 2018 cooling measures will give you there's a lot of takeaway that you can learn from understanding those trends. I would also pay attention to the supply charts. Like I said, the fundamentals don't change over a short period of time. Unlike demand, supply is very inelastic. You have to sell a land today to get a house 4 years later. You cannot sell a land today and expect the house to be built within a year. So supply is inelastic. So what is done today will affect the next year, next 2 years, next 3 years. So once you know what can't really change in the market, you can then make a better decision. I like to tell my clients, If you buy today and a cooling measure or something happens to the market tomorrow and you're panic, means you are not ready to buy. Because if you have understood the fundamentals properly, you know cooling measures are just a pause in the demand, and that prices will continue to go up once the demand flows back into the market. And together we have planned for contingencies like that, plan to still have flexibility in your property plan if something like that happens. So you shouldn't panic if anything happens, because we cannot foresee what's going to happen in the short term, but we have understood what is going to happen in the long term, and anything that happens in the short term do not fundamentally change that. So what are the other things I will look at? Emerging trends in the property market, what we call hidden cooling measures. A lot of people don't know much about this. We talk about that in great detail in my emerging trends video, which similarly will be in the description shortly. Okay, yeah, and so these emerging trends are creating a lot of gaps in the market, gaps that a lot of people somehow don't see, which is why I really urge all of you, all my followers, to go and watch that video and understand these fundamentals, right? The minimum average unit size, the down payment trends moving forward, so that you can see those gaps and then you can make most use of those gaps to your advantage. So, and then I take this opportunity to just run through a very quick fundamental, right? Will prices drop if this run stops? Let's say 2 weeks from now, a month from now, some cooling measure comes in. So like I said, cooling measures are a pause in the demand. They do not eliminate demand from the market, because resident household, its numbers are coming up. There's an increase in the number of singles. There's an increase in household income. There's an increase in affluence. So all those are fundamental demand that will not disappear overnight. So that's it, right? You still have to do your due diligence in what you buy, because if you buy wrong, not only your price will not go up with the average, because we see the trends coming up, right? And this is a PSF chart, okay? So it tracks the average per square feet from 2011 to 2021 today. So I'll share some of the fundamental points to look out for in a property in a later chart lah. So still keep a lookout for fundamentals. You buy the wrong fundamental properties, the prices will not, there's no guarantee that prices will go up with the general trends. Okay, let me just drink a cup of water. So if you are still waiting for prices to come down, or you're under the impression that if cooling measures come, the prices will come down, I really urge you to watch my cooling measures video and also my debunking the myths video to really understand why I and we here at The Right Move firmly believe the prices will continue to go up. The market is fundamentally different today versus pre-cooling measures, right? I won't go into that much detail. I'll just leave it as that. So we will not see prices correcting the way they did pre-2013 cooling measures lah. So let's just say, even if something happens and the price dips slightly, we have to deal with, number one, low supply in the market today, right? There's just really not much supply in the market. Sellers and developers know that if a cooling measure comes or whatever event, external event comes, they will rather just stop selling than shortchange themselves and sell at a lower price. Make sense? If you are owner and you know that the demand is so high down the road, you would not panic. You will just decide not to sell, which is something that we saw very prevalently during the circuit breaker last year. Many owners just decided to put their listing on hold versus being forced to sell at a low price. So number two, right? I expect down payments to come up, as that is a very possible option for the government to do to control prices. For example, they may increase the amount of down payment required from the 25% today to potentially 30% moving forward. We have already seen this happening in places like Hong Kong, like Korea, where down payments can come up to 50% of the value of the property. So it is, in my opinion, one of the best ways to control the prices, because it's not destroying demand, it's actually making the market more safe, more sustainable, because you force people to pay down more for the house lah. It's just that it's quite tough because people have to then save up more money. And then also on top of that, we have the minimum average unit size, making units bigger. So now that units have to be built bigger, for example, Pasir Ris 8, I just saw the smallest 3-bedroom, I believe, is 1,000 square feet, right? 1,000 square feet, imagine that in Ang Mo Kio. So Ang Mo Kio, 2,000 PSF. So you're going to be seeing $2 million 3-bedrooms in the OCR moving forward. That is what is going to happen, yeah. So that's only going to add on to how much we have to fork out for the same kind of units. More expensive prices, higher down payments. So if word of advice, understand the fundamentals, do your planning, and don't wait for prices to drop, basically. So what are some of the fundamentals that I will look at in a property so that, you know, regardless of anything, these things shouldn't change, right? They should still be easy to sell moving forward. Look out for location, right? Location is still important. Basically, it doesn't have to be, when I say location, it doesn't mean you go to the CC, it has to be in the CCR, it has to be the RCR. Location means near to good schools will be a positive, will be a good point, near to MRTs, and near to a place with high upgrader demand, our favorite term. You have point 4 locked in, the other 3 points not there can still yield very, very good profits. Case in point, our good friend at High Park. And I will ask also one last question. What is your long-term goal? So, story time, case study. I feel case study more relatable lah. So this is a very recent client of ours. They are almost a photocopy or perhaps a case study of the census. Dual income, have a kid, pretty strong income. They currently own a private property. So the initial intention was to perhaps buy a second property for own stay, because the current property that they are at is quite small. It's a 2-bedder, and because they have a kid, they foresee that they're going to need a bigger space. So we went around looking, because the focus was on size and location, and we ended up going around in circles, because and ending up looking at developments and struggling to really find value in those units. Either the asking prices were too high, or the launchers had to wait too long. Especially those launchers that they like, that fits the size and the location preference. But those launchers would have pushed their budget really to the max. So what we did was to pull back and ask ourselves this question: what is your long-term goal? So after having that chat, we realized that this next property that we are looking at isn't the final one that we are going to buy, because they are in their early 30s. Their dream and their goal is to purchase a landed property. So with that in mind, whatever that we buy today, we have one very important criteria, is that it cannot be a stumbling block in our journey towards buying that dream property, that landed property, say 5 years, 10 years from now. So with that in mind, with the end goal in mind, we actually work backwards to see which property not only does not jam us from getting to that end goal, it ideally helps us in getting to that end goal. And from there, then we work backwards to really look at what they currently need, or what we have first established as criteria for our search, to establish whether it is a want or a need, to separate these two things. And eventually we concluded that the extra space, that immediate space that we thought we need, was more of a want. We could actually continue with that 2 beta, at least for the next 1 to 2 years. And in any case, that 2 beta can be rented out to get really good rental where they can take to rent somewhere else. And then with that second name now available, what we did was to purchase a investment property that will be easy to sell come the time whereby we have sufficient funds to go for that landed property that we wanted to go to. So long story short, right, instead of focusing on what is the short term, right, really pull out your plan to the long term. Because if you lose sight of that and too focus on what is in the near term, my concern is that you may end up buying something that you will potentially regret, and then buying something that is more of a want versus a need, as a result foregoing or putting your long-term goal at risk. Yeah, so that is the moral of the story. So there's always some different options. It's just how the mindset, like I mentioned, that you adopt, how you really view this whole property planning process, and be creative about it. So in summary, yeah, have the right mindset before moving into your property purchase. Understand the right fundamentals and adopt and use those right fundamentals. Understand the exit strategies. There's always more than one exit strategy. Not just for your current property today, but the property that you're going to buy. And also ask yourself that question, what is your long-term goal? So, my recommendations, yeah? So now at this point, I'm going to say something just to help me with the YouTube algorithm. If you found this video useful, I just urge you to like and subscribe so that it will help us with our YouTube algorithm. For those of you who are not already on our YouTube, head on over and like and subscribe to help me out, right? Help the channel out. Oh, hi Carl, long time no see. Yes, what's next? Recommendations, yes. So for first time buyers and upgraders, okay, I know Elizabeth and I weren't big fans of ECs last year. We didn't really recommend ECs last year lah. But today, with the new benchmark prices being set at close to 2,000 per square feet for the OCR for a place like Ang Mo Kio, and ECs still hovering around the existing ECs, I'm talking about the newer ECs hovering at around the 1,000 PSF, 1,100 PSF. The remaining launches in the market at about 1,004 PSF. I really see good value in the ECs in the market at this point in time. And also because the ECs will take a shorter time to build, because ECs can only start selling after the developers finish the foundation. So regardless, you're going to collect the keys for your ECs in the span of perhaps 1.5 years to 2 years. Not as long a wait time as the BTOs in the market at this point. Yeah, so really do give them do check them out. I have changed my perspective, and because the market has moved, good values in the ECs today. Understand method D. That was that method that I used for that case study earlier. Don't know what is method D? Contact me. I explained to you. I don't want to put it out into the public forum so explicitly. Yeah. Investors, you can look out for remaining units at the current launches. Let me explain why. So this is the big question everybody is asking: are there still undervalued properties? How I see these undervalued properties, perhaps a little contrarian, a little bit different from the conventional wisdom of how you find undervalued properties. Let me explain further. So this is another pitfall, very, very common pitfall, and a pitfall that I somehow been hearing a lot recently. So I thought I can address it one shot. The need to buy on day one to make money. So generally, I would agree with this. Buying it on day one more or less guarantees that you make money. First of all, because there's still going to be a long stretch for the developers to sell their property. So even some of the developments that were launched pre-2018 cooling measures, and after the cooling measures they dropped their price, the prices have recovered to the day one price. So buying day one is good. But what we also want to take is that cautionary tale that I was telling you about in 2018, whereby there were units that were bought right before the cooling measures, they had a reduction in price. I won't mention which projects, but those in the know will know. While it may not happen this time around because of the sheer amount of undersupply in the market at this point in time, but take a look at this example that I'm showing. So this example is Twinview and Whistler Glen. They are in West Coast. So Twinview, the land was bought in May 2018, right before the cooling measure. The land break-even cost was 1,000 PSF PPR. Whistler Glen was bought after the cooling measures, so the break-even cost for the land was 1,255. So their break-even cost was higher. But take a look at this. Twinview sold at a higher median price than Whistler Glen. Why so? It was because the market was so hot before the 2018 cooling measures came in. The developers could afford, even though they bought the land cheaper at 1,000 PSF, to sell it at 1,400 plus PSF. And they were almost sold out on day one. Versus Whistler Glen, whereby the developers bought the land after the cooling measures, where the demand was a bit lower, so they couldn't afford to sell at such high profit margins. So I would pay extra attention to this, especially in a market like today. The developers know the demand is very, very high. There's a lot of FOMO in the market. So do pay attention to this, because if you buy day one at Twinview, you are actually not in such an advantageous position as opposed to Whistler Glen. But this is a bit hard to gauge, right? Because Whistler Glen was coming out later. You were at Twinview at that point in time. You couldn't foresee what land was sold or what's going to happen later on, right? But this is just an example. What I want to emphasize next will be a chart that I shared actually the last Facebook Live. So this chart shows what is going to be the future prices. So follow me. The whole idea, we try to merge it together. So people, right, there's a very common misconception that you have to buy day one. But while yes, it's good, today there is a lot of balanced units still in the market that the developers have bought at the old price. Of course, the caveat is that they are likely to be 60-70% sold through. The thing is, do they represent more value today at this kind of prices, this kind of average prices? Take a look at, let's say, Avenue South, 2,100 PSF. So Avenue South is in the RCR, it's near Cantonment, it's near the Greater Southern Waterfront, 2,100 PSF. Versus Ang Mo Kio Avenue 1, that will potentially launch at 2,000 to 2,200 PSF. So I'm not sure of Avenue South sell-through rate, probably more than 50 to 60%. Which one represents most value to you? Should you be overly focused on day one prices and buy the OCR at the new benchmark prices, or take a look at a development at the old price, albeit 50 to 60% sell-through rate? Okay, so how do help us take a look at this we can overlap. What I would suggest, overlap fundamentals. That same fundamentals that I highlighted earlier: location, upgrader demand, MRT, schools. Use that as a fundamental. Then slot in. Has the developers really increased their prices significantly? You'll be surprised. There'll be quite a number of these developments that the developers have not raised the price that much. So in my opinion, when and if there are still developments available in the old price point, I feel they represent actually pretty good value versus being overly focused and having to buy a development in day one at the new benchmark prices. Another example, right? Let's think about it. Okay, the buyers that have bought earlier, so those already launched, they have bought earlier, they have bought 2 years ago, for example, they have already paid quite a fair bit in terms of interest. So a $1.5 million purchase, 30-year loan at 1.5 interest, that's $7,500 worth of interest that they have already paid. And in the scenario that they have already gone out to rent, and assuming $2,500 rental over 2 years, that's $60,000. So the developers may have raised the price $30,000 to $40,000, but you buy today, 2 years later after the first guy at $30,000 to $40,000 more. Would that be a good value to you? I would certainly think so, because the first day buyer, what he bought at day one price, he have incurred a cost of close to $70,000, while you buying it later, having continued to stay in your house, even though you buy $40,000 more in terms of net price, your actual cost is lesser than the first time buyer. So it's another way to take a look at it. Yeah. So the next point, are you buying into an investor-centric or an owner-occupier-centric development? Right, I speak about this quite a bit in the previous videos already. This is a bit more advanced, and I talk about it in depth in my new ebook. I will talk about that ebook later on, right? So those who follow us religiously will know what I'm talking about, right? That is another gap that I see in the market today. And what are the kind of balance units available lah? Most of them are the big units catering to upgraders, because a lot of the upgraders are not overly inclined to sell and rent. They are waiting for the time to come closer to TOP before they sell their property and buy, so that they don't have to incur too long rental. So how do you like piece all this together and make it work for you and make it make sense for you as an investment? So I came up with some case studies. Pardon me if it's a bit too small and you can't see it. So I put out an example. The top left hand corner is the profits made by Hyde Park Residences, right? Our favorite case study. They bought in 2015 and they sold in 2021. Remember these 2 years, 2015 and 2021. Okay, I will explain to you why is it so important in the last few slides. The profits made by the owners that bought in later, basically not the first day owners, were still very, very respectable, right? We see annualized gains ranging from 2.4% to 5.4%, even though he bought in May 2016. Almost 1 year later after the launch, and also at a higher price, right? The launch prices were at about 900. He bought in at about 1,000 PSF. Still made very good profits. Yeah. And this is another example. So I'm comparing. So on the bottom part was that same chart from Hyde Park Residences, the owners that bought in later, not on day one. You see them averaging annualized profits of about 2.4 to 5%. I would average it out to be about 3.54%. You compare this to the table on top. The table on top is for Wisteria. So Wisteria was launched in March 2016, where the market was already starting to pick up. And you notice the profits that these folks make, the annualized profit, it will not win the profits of the second group of buyers at Hyde Park Residences. So what am I trying to get at with this case study? Fundamentals are important, right? Look at the fundamentals first and look at, does that development make sense? Dig deeper. it doesn't mean you buy day one is a better option, because you may be buying day one price at a much higher price than, say, some of the better deals being available in the market today. And I will end off with the two golden charts and how do you use. So for those of you who stayed with us till the end, this is a very, very powerful two charts to give you an idea on how to make the maximum use of the market to your advantage. Okay, remember that previous example, Hypark bought 2015. So the table on the right illustrates the TOP supply by year. So you notice TOP supply from 2014 to 2025. Oops, going up 2014, peaking at 2016 and coming down. So last year and this year, it's actually, we have quite low numbers of TOP supply. So that Hypark example, they bought in 2015 and they sold in 2021, 2020, 2021 during a period of low TOP supply. So ideally you want to sell during a period of low TOP supply to maximize your gains, because you don't have that many competition. So the table on the left, which I talked about earlier in this presentation, they bought it during a period whereby the supply was dwindling. It's a very similar trend as today during a period of the old price. So 2015, notice how the prices was still low. Where they bought it at the old price, and they sell it in 2021 at the new price. Old price, new price. So this is very, very critical. If you understand this properly, it's very, very powerful to use, because these are supply side charts that do not change in the short term. Okay, so if you need more details on how to utilize these charts, you can check out our latest ebook. So I know I owe you guys quite a number of ebooks, but this one is almost done. It should be done this weekend, and we are ready to send it out. So what we talk about in this ebook is a condensation of a lot of points that I talked about in the presentation. I talk a lot about that whole investor versus owner occupier. How do you use that to your advantage in the coming market? So those of you who are interested, right, drop me a text. This is my contact, or drop Elizabeth a text, and we'll send it to you this weekend or early next week once it is done. So again, my apologies for the delay in the previous books. But they will be out soon, and I have on record those who have expressed interest. Yeah, so I will send it to you as soon as I can. If you like this book, let me know. It will come to you a lot sooner. So that's the end of what I have to share today. Hi Edmund. Hi Leon. Yeah, so it's Q&A time. Yeah, YK, correct. Day one best price is true most of the time, but I want to go one step deeper, right? Day one price versus other existing units, right? Especially in today's market. Yep. Any questions, guys? Thank you so much for tuning in, right? Help me like and share, help me like and subscribe. So for those of you who want the book, drop me a text. I'll send it to you once we are done. We are almost done already, right? Hit the like if you like the likes. So happy with my likes. Okay? If we have no other questions, thank you so much for joining us today. Till next time, bye-bye.